Stop what you are doing right now. I need you to look at a number that the financial media has not reported today. Not because it is hard to find, because it does not fit the narrative they are running, because it complicates the headline, because explaining it would require them to explain something about how silver and gold relate to each other at specific points in a bull market cycle that most financial journalists do not understand, and most of their audience has never been told. Here is the number. Silver is up 1.6% on the week. Gold is down 1.4% on the week. On the same week, in the same market, responding to the same geopolitical headlines, the same Federal Reserve uncertainty, the same energy inflation pressure, the same Project Freedom announcement from President Trump that sent both metals lower on Monday morning. Same inputs, different outputs. Silver beating gold on the week by more than 3 percentage points, while every headline you read today is talking about gold pulling back from $4,644 and precious metals facing headwinds from rising rates and Iran war uncertainty. Today is Monday, May 4th, 2026. Asian guy here, and what I need to walk you through right now, because nobody else in this space is talking about it today, is why that 3 percentage point divergence between silver and gold is not a coincidence. It is not noise. It is not a random one-week fluctuation that means nothing. It is a signal, a specific, historically documented, mechanically explainable signal that has appeared at the same point in every major silver bull run of the modern era. And the investors who recognized it in previous cycles, who understood what it meant and why it was happening, were the ones who captured the most explosive phase of the move that followed. I know what you are thinking right now. You are thinking, silver up 1.6% and gold down 1.4% in a single week is not exactly a earth-shattering development. Markets move, metals diverge, this happens. And you would be right that in isolation, a one-week divergence proves nothing. But I am not asking you to look at 1 week in isolation. I am asking you to look at where this divergence is appearing in the context of the broader cycle. I am asking you to look at what the historical record says happens after this specific signal fires at this specific point in a precious metals bull market. And I am asking you to look at the mechanical reasons, the supply-demand dynamics, the positioning data, the macro backdrop, that explain why this divergence is happening right now and what it is telling you about where silver goes from here. Let me show you the engine. Because the price on your screen is the exhaust, and the engine is running a signal right now that you cannot afford to miss. Let me start with the mechanics of the gold-silver relationship, because you cannot understand why today's divergence is significant without first understanding how these two metals normally move together and what it means when they stop. Gold and silver are monetary siblings. They both respond to the same macro triggers. Dollar weakness pushes both higher. Dollar strength pushes both lower. Rising real interest rates pressure both. Geopolitical stress drives safe haven buying in both. Central bank accumulation supports both. Because they share so many of the same demand drivers, they tend to move in the same direction most of the time. When you plot gold and silver on the same chart over any given month or quarter, the correlation is typically very high. They go up together, they go down together, they correct together, they recover together. But there are specific moments in a precious metals bull cycle when that correlation breaks down. When silver stops following gold and starts moving independently. When silver's own fundamental drivers, its industrial demand story, its supply deficit, its unique positioning dynamics in the COMEX futures market, begin to assert themselves with enough force to pull silver away from gold's gravitational influence. And those moments of divergence, where silver separates from gold and begins to outperform, are not random. They are not arbitrary. They happen at a very specific point in the cycle. And that point is the transition between the mid-cycle consolidation phase and the beginning of the final, most explosive leg of the bull market. Think about what the mid-cycle consolidation looks like. Gold runs hard, pulling silver along with it. Both metals attract speculative buying. Open interest on COMEX expands. Managed money goes long in size. The price moves reflect both the fundamental thesis and the speculative positioning premium layered on top of it. And then the consolidation hits. The speculative longs get shaken out. Margin calls cascade. Both metals sell off. The correlation holds. They fall together just like they rose together. And then, during the base building phase that follows the correction, something starts to change. The fundamental buyers, the industrial users, the long-term monetary investors, the central banks, the sovereign wealth funds, begin to quietly accumulate at levels they consider attractive. And because silver's fundamental demand picture is structurally more urgent than gold's in the current environment, those fundamental buyers hit the silver market with a disproportionate force relative to what they are doing in gold. That is what creates the divergence. Not speculation, not momentum. Fundamental buying pressure that is stronger in silver than in gold, reasserting itself after the speculative froth has been cleared. And when you see silver outperforming gold on a week where the macro headlines are negative for both metals, a week where Project Freedom failed to produce a peace deal, where gold fell 1.4%, where energy prices are still elevated and rate fears are still present, what you are seeing is fundamental buying pressure strong enough to overcome the negative macro headwinds. That is not weak-handed buying. That is conviction buying. And conviction buying at the base of a consolidation, in a smaller market with tighter physical supply, is the exact setup that precedes the most dramatic price moves in silver's history. Let me take you through the historical evidence because the pattern I am describing is not theoretical. It is documented. It is repeated across every major precious metals bull cycle of the modern era, and the consistency of that repetition is the reason serious investors track the gold-silver divergence signal as carefully as any other indicator in this market. Start with the 1979 to 1980 cycle. By mid-1979, gold had already run significantly from its post-Bretton Woods lows. Silver had followed, but the gold-silver ratio was still elevated relative to where it would eventually go. And then, in the summer and fall of 1979, silver began to diverge. On weeks when gold was flat or slightly lower, silver was moving higher. On weeks when gold was up, silver was up more. The ratio began to compress. Slowly at first, then with accelerating velocity. Between August 1979 and January 1980, approximately 5 months, silver went from around $9 per ounce to $50. Gold went from around $300 to $800 during the same period. Both metals had enormous moves, but silver's percentage gain was more than 3 times larger than gold's. The divergence signal that appeared in mid-1979 was the early warning that silver was about to shift from following gold to leading the entire precious metals complex. Now look at 2010 to 2011. Gold had recovered strongly from the 2008 financial crisis lows and was making new highs. Silver had recovered too, but was trading at a ratio to gold that was historically elevated, meaning silver was cheap relative to gold by historical standards. And then, in late 2010, the divergence began. Silver started outperforming gold on a week-by-week basis. The ratio began to compress. And between September 2010 and April 2011, 7 months, silver went from approximately $20 to $49. Gold went from approximately $1,250 to $1,575 during the same period. Again, both metals moved. But silver's percentage gain was more than 4 times larger than gold's. The divergence signal appeared, the ratio compressed, and the investors who recognized the setup captured a 145% gain in silver against a 26% gain in gold over the same period. Now look at today. Gold is down 1.4% on the week. Silver is up 1.6% on the week. The gold-silver ratio, which was sitting near historically elevated levels during the mid-cycle correction, is beginning to compress. Slowly, quietly. While every headline focuses on gold's pullback and the macro headwinds facing both metals, the divergence signal is firing, and the historical pattern says this is not the moment to be reducing silver exposure. It is the moment to be paying very close attention to whether this divergence sustains and accelerates over the coming weeks. I want to be precise here because precision matters, and I do not want to overstate what 1 week of data tells you. 1 week of silver outperforming gold does not confirm the beginning of the final explosive leg. It is a data point. It becomes a signal when it is accompanied by the right fundamental context. When the supply-demand picture, the macro backdrop, and the positioning data all align with what the price action is showing you. So let me walk you through that context now, because in the current environment, the fundamental alignment behind today's divergence is as strong as I have seen it. The divergence signal only matters if it is being driven by fundamental buying rather than speculative noise. So let me show you the 3 fundamental forces that are creating disproportionate buying pressure in silver relative to gold right now, and explain why each of them is structural rather than temporary. The first force is industrial demand acceleration. Silver's industrial demand story has reached a point of critical mass that gold's demand picture simply does not have. Gold is primarily a monetary metal. Approximately 90% of gold demand is investment and central bank buying. Only about 10% comes from industrial applications like electronics and dentistry. Silver is the opposite. Approximately 60% of silver demand is industrial. Solar panels, semiconductors, electric vehicle components, medical equipment, water purification, and now the AI infrastructure build-out we covered in a recent video. When industrial demand accelerates, it creates buying pressure that is independent of the macro environment. It does not care about the Fed. It does not care about the Iran situation. It does not care about whether Project Freedom succeeds or fails. Industrial users need silver to keep their production lines running. They buy when they need it, regardless of the macro headlines. And right now, with $715 billion in AI capex committed by Meta, Alphabet, Microsoft, and Amazon, nearly double last year's $375 billion, the industrial demand for silver is accelerating precisely when the macro headlines are creating the most bearish sentiment. That combination, accelerating fundamental demand during peak bearish sentiment, is the definition of a market setup. The second force is the positioning reset. During the mid-cycle correction, managed money, the speculative institutional funds trading COMEX futures, sold silver faster and more aggressively than gold. They reduced their silver long exposure to levels that are now historically low relative to the size of the market. This is the same phenomenon we discussed in previous videos, the clearing event that creates the compression before the release. But here's the crucial point about where we are now. As the divergence begins, as silver starts outperforming gold on a week-by-week basis, the managed money funds that reduce their silver exposure during the correction start to notice. Their momentum models start to pick up the relative strength signal. Their risk managers start getting questions about why they are underweight silver when silver is outperforming. And when managed money decides to rebuild silver exposure, when those funds start buying COMEX futures to restore their position, they are buying into a market where physical supply is tight, where registered COMEX inventory has been declining, and where the industrial buyers are already competing for supply. The managed money buying amplifies the fundamental buying. The price moves, the momentum signals strengthen, more funds pile in, and the self-reinforcing dynamic that defines the explosive final phase of a silver bull market begins. The third force is the Project Freedom paradox. Trump announced this weekend that the U.S. will escort ships from non-involved countries safely through the Strait of Hormuz. The market's initial reaction was to sell gold, interpreting this as a step toward de-escalation that reduces the safe haven premium. But here's what the market is missing. Project Freedom does not resolve the fundamental energy supply disruption. It does not reopen the strait to Iranian oil exports. It does not reduce Brent crude from $112 per barrel to $80. It does not eliminate the inflation pressure that is keeping the Fed on hold and creating the negative real rate environment that structurally supports hard assets. Project Freedom is a humanitarian and diplomatic gesture. It is not a macroeconomic resolution. And the fact that silver held up and actually gained on the week while gold sold off on Project Freedom optimism tells you something very important about where the fundamental buying in silver is coming from. It is not coming from geopolitical fear. It is coming from industrial demand and supply deficit dynamics that exist regardless of whether the Strait of Hormuz is open or closed. That is what makes today's silver outperformance genuinely significant. It is not a safe haven trade. It is a fundamental trade. And fundamental trades are more durable than safe haven trades. Now I need to talk about this week's macro calendar because there is a specific event coming on Friday that has the potential to either confirm or disrupt the divergent signal we are watching develop. The April jobs report drops Friday morning, and in the current macro environment, where the Fed is the most divided it has been in decades, where inflation is running at 3.5%, where 4 officials dissented hawkishly at the last meeting, where traders are now pricing in a possible rate hike in 2027, the jobs number carries more weight for precious metals than it has at any point in the past 2 years. Here is why. The hawkish Fed dissenters, the 4 officials who wanted to raise rates at the last meeting, are making their case based on 2 pillars. First, persistent inflation. Second, a labor market that is too tight to allow inflation to naturally decelerate. Initial unemployment claims just hit their lowest level in nearly 50 years. The labor market, by every measure the Fed watches, is not softening in a way that gives the Dubs ammunition to argue against further tightening. If the April jobs report comes in strong, above 200,000 payrolls, unemployment rate holding near current levels, wage growth still elevated, it validates the hawkish dissenters. It increases the probability of a 2027 rate hike. And in the short term, that is bearish for precious metals because it strengthens the narrative that rates stay higher for longer. Gold would likely sell off on a strong jobs number. But here's the critical question for the divergent signal. Does silver sell off with gold on a strong jobs number? Or does silver hold, or even gain, while gold falls? Because if silver maintains its outperformance through a macro headwind that hits gold hard, the divergent signal gets dramatically stronger. It means the fundamental buying in silver is powerful enough to absorb selling pressure that the gold market cannot absorb. And a silver market that absorbs selling while gold falls is not a market that is getting ready to break lower. It is a market that is building the base for the next explosive move higher. Conversely, if the jobs number comes in weak, below expectations, rising unemployment, slowing wage growth, the rate hike probability drops. The Fed pivot narrative comes back. Both metals rally. But in that scenario, silver's rally will likely be larger than gold's because silver has more ground to make up from the mid-cycle correction, and because the managed money funds rebuilding silver exposure will be buying into a positive momentum environment. Either way, strong jobs or weak jobs, the setup for silver relative to gold is favorable. The divergent signal holds in both scenarios. That asymmetry is the definition of a strong risk-reward position. Let me close with what this means practically, because frameworks without application are just intellectual exercises. And I do not make these videos for intellectual exercises. I make them so that you leave with a clearer picture of what the market is actually doing and what that means for the decisions you are facing. Silver is up 1.6% on the week. Gold is down 1.4% on the week. The divergent signal is firing. The historical record says this signal appears at the transition between mid-cycle consolidation and the beginning of the final explosive leg. The fundamental context, industrial demand acceleration, positioning reset, Project Freedom paradox, all support the interpretation that this divergence is driven by genuine fundamental buying rather than speculative noise. And the April jobs report this Friday creates a binary outcome that in both scenarios is relatively favorable for silver's relative performance against gold. Now here's what happens next if the pattern from previous cycles holds. The divergence that is quiet and unreported today, the one that no headline is covering because a 1.6% weekly gain in silver is not a dramatic number in isolation, becomes visible. It becomes something that analysts at the major banks start noting in their weekly commodity reports. It becomes something that the managed money positioning models start signaling. It becomes something that the financial media, which ignored it this week, starts covering in 3 or 4 weeks when the cumulative divergence is large enough to demand explanation. And by the time the mainstream is covering it, the investors who recognize the signal today, who understood the mechanics, who saw the historical pattern, who positioned ahead of the narrative, have already captured the early part of the move. This is how precious metals bull markets work. The signals appear quietly, in data points that do not fit the prevailing narrative and therefore go unreported. Silver up 1.6% on a week when gold is down 1.4% does not generate a headline. It generates a footnote at the bottom of a commodity update that most people never read. But the investors who track the ratio, who watch the divergence, who understand what the relative performance of silver versus gold is communicating about the position of the cycle, those investors know what the footnote means. They know what comes after the divergence signal in the historical record. They know that the quiet weeks, the weeks when nobody is talking about what silver is doing, are the weeks that matter most for positioning. The signal is firing. It is firing quietly, as it always does at this stage of the cycle. And the window between when the signal fires and when the mainstream narrative catches up, that window is the opportunity. Not the window after the move is obvious. Not the window after the financial press has declared silver's rally confirmed and safe to discuss. The window right now. When silver is up 1.6% on the week, and the headline is about gold pulling back on Project Freedom optimism, and nobody is asking why silver is doing something different. Ask why. The answer is in everything we just walked through together. The answer points in one direction, and that direction has a price destination that makes $76 look like the opening paragraph of a very long story. This is Asian Guy. If this breakdown gave you a framework that the weekly price chart alone cannot give you, a way to read silver's quiet outperformance as a signal rather than noise, a way to connect the historical pattern to the current fundamental context, a way to understand what the divergence is actually saying about where we are in this cycle. Like this video and share it with one person who holds silver and needs to understand why the quiet weeks are the weeks that matter. The divergence is the signal. The signal is firing. Do not wait for the headline to confirm what the data is already saying.